The IMF has downgraded their outlook for growth in many parts of the world. I think much of the strain we're seeing reflects the impact of Russia's brutal war against Ukraine, which has raised energy prices. Of course, he's weaponized natural gas, which is causing huge price spikes and energy strains in Europe. We still see the impact of COVID in China and the slowdown in Chinese growth. And with high inflation and tightening monetary policy in many advanced countries, emerging markets from really all of these factors are suffering many stresses. So there's a lot to talk about. But from the perspective of the United States, I think the United States is doing very well.
8.58. Sorry, $8.58. Oh, are you sure? Thank you. Yeah, you're welcome.
And are you concerned about, just one more economic one, are you concerned about the strength of the dollar right now?
I'm not concerned about the strength of the dollar. I'm concerned about the rest of the world. Does that make sense?
Can you explain that?
Yes. Our economy is strong as hell.
In the meantime,
we are expecting LEI to come in down 0.1%. We have 3 scoops instead, down 0.3%. This means we now have 6 months in a row of negative reads on leading economic indicators, and 6 out of the last 8, considering this is August, have been negative. Quite a historic run. It seems as though leading economic indicators are leading, and the equity markets certainly seem to be following. Interest rates are guns hot across the curve.
Amazon.com founder Jeff Bezos became the latest business leader to warn about the health of the U.S. economy, telling his Twitter followers late Tuesday to, quote, batten down the hatches. The tweet was in response to comments from Goldman Sachs CEO David Solomon, who said in a CNBC interview that it was, quote, time to be cautious, referring to the state of the economy. Solomon's comments echoed those of JP Morgan Chase CEO Jamie Dimon, who said last week that the U.S. and the global economy could tip into a recession by the middle of next year. Microsoft this week became the latest U.S. tech company to cut jobs or slow hiring after a media report said it laid off under 1,000 employees across several divisions this week. Meta Platforms, Twitter, and Snap, the maker of Snapchat, have all either announced job cuts or scaled back hiring in recent months. Billionaire Elon Musk also said his electric car company Tesla needed to cut jobs, warning colleagues in early June that he had a, quote, super bad feeling about the economy.
The midterm elections are 4 weeks from today. The economy remains top of mind for voters. JP Morgan Chase CEO said the U.S. is likely to enter a recession in the next 9 months. Bank of America says the U.S. could start losing 175,000 jobs a month. Gas prices are on the rise again. Should the American people prepare for a recession?
No. Look, they've been saying this now. How every 6 months they say this. Every 6 months they look down the next 6 months and see what's going to happen. It hadn't happened yet. It hadn't. There's no guarantee that they're going to. I don't think there will be a recession. If it is, it'll be a very slight recession. That is, we'll move down slightly. Look.
But all I can say is all is well, and we're expecting light at the end of the tunnel, inshallah. At the end of the tunnel, not tunnel.
All right. Today is Thursday, the 20th of October. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. Let's start by this. Yesterday, we were talking about Liz Truss, and a few hours later, what do you know, she's gone. You see, the British public has been saying, hey Liz, time's up. Gotta step down. But she remained defiant. No, I'm not gonna step down. But it's one thing when the public demands you step down. It's another when the maverick of Wall Street says, step the down. And immediately, Liz Truss announced her resignation. Take a look. And this, ladies and gentlemen, marks the shortest tenure of any British PM in history. And now, of course, Liz can concentrate on what she's really passionate about, which is the Saliva Ukraine agenda, as you can see from the pen. Now she can dedicate all her time to what she really cares about. And it's really hard to feel bad for her because, number one, she cost the British public over £20 billion. And of course, the number is way, way bigger because when you add all of these extra mortgages and credit card rates that folks have to pay, now we're talking about over £100 billion. Not to mention the kiss of death to the Queen. And the moral of the story here is, you gotta know when to take risk and when not to take risk. You see, Mrs. Truss took unnecessary risk. She was so obsessed with being the next Thatcher. In the meantime, she forgot that the country is facing the highest inflation rate in 40 years. And cutting taxes when you have the highest inflation rate in 40 years, that is a moronic kind of risk-taking. So it's not just know when to take the risk and when not to take the risk. It's also use your head, common knowledge, common sense, and stop defying the rules. Economic rules, that is. This is the dumbest kind of risk-taking. I mean, it's one thing if you're in Turkey and you happen to be Erdogan and you decide to cut rates by 150 basis points when you got an inflation rate of 83%. But that's Erdogan. They got no democracy over there. In the UK, they got democracy. And this is not going to work. You take the risk, it blows right in your face, you're out. End of story. And now the British media and the public are talking about bringing Boris Johnson back. Ay, ay, ay. You know, if you're going to keep shuffling these clowns, you're going to get what you deserve. So don't be surprised that by the end of this process, Britain will become a third world country. But immediately after the resignation by Liz Truss, the British pound shot up higher, and I say initially because in turn the dollar went down, and stock market futures here in the United States responded to the decline in the dollar by pushing their way higher. And it was a positive day until the British pound decided to melt down slowly but surely, and the dollar started to find a footing, and the stock market rally stalled. And then came the next chew. Fed Governor Harker said that he sees more rate hikes to come. 75 will become 100. And if you thought it's 2 and pause, it's actually 4 and pause, and then it becomes 10 and pause, and then it becomes holy shit, we're blowing everything up. Because we got no choice. Inflation is in charge. And Fed Harker sees inflation only coming down to 4% in 2023. Let me fix this one for you. Inflation only coming down to 6% in 2023. And this, of course, echoes what Neil Kashkari said just a few days ago when he admitted that the Fed cannot pause rate hikes. In other words, no Fed pivot because inflation, in this case, core inflation, is accelerating. And he doesn't see any sign that core inflation is going down. If anything, core inflation is trending higher now. And immediately, the stock market went down, erasing all of the gains from the morning. And then came the third shoe after the bell. Snapchat reported earnings, and the headline reads, Snap's slowing ad growth sends inflation fears through the tech sector. And give us a live shot for the quote for Snapchat stock. Let's see and take a look. And ooh. Oh, no. The stock of Snapchat is down over 27% after the bell. Call the fire department, call the plunge protection team, call Kimberly-Clark and ask for more Kleenex, call Procter & Gamble and ask for more diapers, call your parents because you're gonna need them tomorrow. Earnings season optimism, baby. Here we go. But anyhow, we have to talk about the economy and what's going on here because allegedly a rumor started in Baskin-Robbins up in Portland, and the rumor says that the economy is as strong as hell. So let's see if it is, because this week we got a lot of macro data. Without further ado, here it is, in focus tonight. The art of delusion. Up is down, down is up, east is west, and the economy is doing great. We now know that the economy is not doing great. The economy is actually in stagflation. Stagflation happens when inflation is high, yet the pace of economic activity slows down tremendously. Hence, we see stagnation combined with inflation. You combine the two of them in a blender, you get a stagflation phenomenon. And in this economy, we're seeing the inflation rate moving higher, meanwhile GDP moving down. And this week, we got more alarming indicators that we are indeed in stagflation. Take, for example, the New York Fed Empire Manufacturing Survey. And I'm not going to read everything for you here, but look at these little headlines over here. It says conditions weaken. On the other hand, right next to it, it says input price increases pick up. So conditions weakening, prices moving higher. This is stagflation. Look at this. This is the Empire Manufacturing Index. It is trending down, and we don't see these kind of negative readings unless we are heading into or already in a recession. And when we look at the current conditions, the headline reading is down 7.6%. But look at this, new orders, zero growth, nothing. Shipments down 19.9, yet when we move on to prices paid, the reading is up 9 points month over month. So again, pace of economic activity is moving down, prices moving higher. But what about the future, Maverick? Here's the future for you. And hint, doesn't look good. The headline reading in the forward-looking indicators, down 10 points. New orders, down 8.3 points. Shipments down 14.5 points. When it comes to prices, up 1.4 points. So here we go. Even in the future, bro, the pace of economic activity is moving down, yet prices moving higher. And today we got the Fed Philly Manufacturing Index, and it is negative. It is indicating a recession. No good news here. Meanwhile, the indicator for prices is moving higher again. And when we look at the details, the question is, what is your evaluation of the level of general business activities? Down 9.9%. Listen to this. New orders down 17.6 points. Unbelievable. However, prices paid up 29.8 points, and then prices received up 29.6 points. This is an economic disaster. This is stagflation. It's right before your eyes. The numbers don't lie. And to get us out of stagflation, the Fed has to kill the inflation part of stagflation. Unfortunately, there is no surgical approach to extract inflation without damaging the entirety of the economy. So to defeat inflation, the Fed will have to kill the whole enchilada. And you heard all of these banksters, Jamie Dimon, the Goldman Sachs guy, and now we got Jeff Bezos. Everybody's warning that this economy is going down, and it's about to go down big. Of course, that doesn't impact them. They're going to do fine, but they see the numbers in their own companies. These banks, they see the leading indicators. Amazon sees the leading indicators. Orders are slowing down, etc., etc. We also got another billionaire, Carl Icahn, aka Gordon Gekko, who warns that the U.S. economy has tough days ahead and blames the Fed for painful inflation. And the Fed doesn't deny any of that. The Fed says, Kashkari, the demon from Minneapolis, he says he doesn't know if the central bank can bring inflation down without triggering a recession. And I say, I know, Neil, I know. You're not just going to trigger a recession. You might trigger a depression. Let's party like 1929, baby. Get the champagne ready. And even Ray Dalio says that he sees the classic early signs. And he warns that the stock market will go down even further before the recession hits. So stock market crashes first, and then you start to see the bad news in the actual economy. And when we talk about the strong as hell economy, come on, man.
Come on, man.
Well, here's strong as hell for you. Over 50% of CEOs say they're considering cutting jobs over the next 6 months, and remote workers may be the first to go. So you got your nice job in California paying you what, over $100,000? Yet you live in Idaho. My employer is nice. Yeah, he was nice in 2020, 2021 amidst the mania in the economy. But now you're going to see nice turning into not so nice. And the worst part of it, they're not going to send George Clooney to fire you. They're going to do it via Zoom. But this is the strong as hell economy. And now even economists in Bloomberg, they put the recession odds at 100%. It's in the bag. The latest recession probability models by Bloomberg economists Anna Wong and Eliza Wagner-Winger forecast a higher recession probability across all time frames, with the 12-month estimate of a downturn by October 2023 hitting 100%. Listen to this, up from 65% for the comparable period in the previous update. Here we go. And today we got leading economic indicators, and they're down again. And this happens to be the 7th time when leading economic indicators declined this year. Now, are they lying? Are they saying that this is a mild recession? Of course not. If it was a mild recession, it would be a down reading twice, 3 times a year. This time around, it's one after the other, indicating that this will be a severe recession, not a mild one. And when we look at small business confidence, for example, the reading is at all all-time low. 33% say that small business conditions are in good conditions. 28% say that they saw revenue decrease. When it comes to inflation, 43% of small businesses say inflation is the biggest threat to business. 77% expect inflation to continue to rise. Hence, inflation expectations are moving higher and higher and higher. About 80% of Americans say that grocery store inflation is very concerning, while about 60% say inflation in general is very concerning. Not just concerning, very concerning. But hey, the economy is strong as hell, right? And are you excited for the upcoming Halloween holiday? Well, I am, and if you send your kids to my door asking to trick or treat, I'm gonna smack them in the face and send them back. Better yet, I'm gonna bus them to DC, to the Fed and to the White House and say, go ahead and trick or treat over there. You know why? Because this is going to be the most expensive Halloween in history. Halloween candy prices went higher year over year by 13.1%. When we look at inflation all in all, specifically food inflation, when we look at fruits and vegetables, for example, the prices are up 10.4% year over year. For meat, poultry, fish, eggs up 9% year over year. When it comes to dairy products, for example, up 15.9% year over year. And of course, the majority of Americans are becoming more and more and more concerned about the inflation in food prices, be it dairy, be it meat, be it produce. It doesn't matter. The number of people who say that they're becoming more concerned is moving higher and higher and higher. And this inflation has been destructive so far. Matter of fact, this has been the biggest drop in U.S. household net worth in history. And we're just getting started, baby. The wealth destruction as a share of a GDP is nearing the financial crisis. But hey, there is no recession coming, right? And to cope with all of this, what is the American consumer doing? The answer is they're swiping those credit cards up and down, up and down, up and down. And look at this. Consumer credit is exploding higher. You run out of your savings, your wages are not good enough to keep up with this inflation, you're going to resort to the credit card. And the reason is Americans now have to spend $445 extra every month because of inflation. Now, your employer is not going to be out of the goodness of his heart, her heart, and say, hey, here's an extra $500 a month. That's not going to happen. So if your main wage cannot cope with inflation, what do? After you've finished swiping those credit cards up and down, up and down, up and down. And you now feel like the 66% of Americans who say that they're now worse off financially than a year ago because of inflation. Well, according to the surveys, Americans say that they're going to buy fewer items in the grocery store. In other words, they're going to starve. So when your kids are throwing a fit in the grocery store, can I buy this? Can I buy that? Crying and throwing their feet all over the place, tell them to shut the hell up. And if you got a problem, talk to Jerome Powell and Joe Biden. These two are responsible. But again, your wages are shit wages. They don't pay for inflation. And you maxed out your credit card. What do you do next? The answer is you look for another job. Matter of fact, 38% of American workers have looked for a second job, while an additional 14% are planning to look for a second job. So no wonder why when they say, hey, the economy is doing fine, look at the unemployment rate, look at how many jobs we're creating. It's not really jobs we're creating, it's actually people looking for second, third jobs. That's what's going on. And on top of that, what else? If you cannot find a second job, you don't have the time to find a second job, how about you move to a cheaper city? 18% of all employees say they have considered moving to a cheaper city. And if you maxed your credit card and you looked for a second job and you considered moving to another city and all of that is no-go, how about you work harder? You work overtime, extra shifts, because among all employees, 57%, the vast majority say they want to work overtime or extra shifts to cope with inflation. This is a disgrace, ladies and gentlemen. This is not as strong as hell of an economy. This is a shit as hell economy. And again, we're talking about the heart, the backbone of the economy. We're talking about the consumer. So are we going to have really decent corporate earnings if the consumer is collapsing? Are we going to see the stock market doing fine when the consumer is not spending more buying goods and services from these companies whose stocks are trading in the market? And it's about to get even worse. About 20 million American homes are now behind on their energy bills. What are they going to do? Are they going to be shut down? Or are they going to be bailed out? What's going to happen here? And these bills will go higher and higher and higher. In New England, specifically because the supplies of fuel are at all-time low. We're now now talking about blackouts in New England this winter season. This is not Ukraine. This is not Zimbabwe. This is the United States of America, a country that somehow has trillions and trillions and trillions of dollars to print to prop up the equities and real estate markets, but somehow the people have to freeze this winter season and experience blackouts. So again, from all of these economic indicators that I just shared with you and the opinions of billionaires and bankers and corporate leaders and economists all over the place saying this economy is collapsing as we speak, we might see the biggest and most aggressive recession that we have seen in a long time. You tell me, is this really an economy that is strong as hell? Well, the only point that the advocates for, this is a strong economy, the only point that they got is, employment is pretty good. The jobs market is pretty good. The unemployment rate is down, and we are creating jobs. Are we really creating jobs? Because all in all, since February 2020, the economy created a little over 30,000 jobs, meaning there were no new legitimate positions added and created in this economy. All we did is recover some of the jobs that we lost from the Great Panic back in 2020. And the majority of the jobs that are legitimately created in the economy, the majority of them are Amazon jobs in transportation and warehousing, because when you print trillions of dollars and you stimulate the demand artificially, folks are going to buy shit from Amazon and they have to fill more jobs. Well, what happens when this demand goes down? Because the consumer ran out of stimmies, ran out of savings, already maxing out their credit cards. They cannot find a second job because the economy is slowing down, yet inflation remains higher. Amazon gonna have to get rid of a lot of jobs. And now we got Jeff Bezos saying, hey, this is really bad. Watch out, or whatever the he said. The bottom line is, Amazon will be oversupplied with workers. They're going to get rid of thousands, if not millions of workers. We also added, quote unquote, jobs in professional and business services. You have all of these software technology companies, all of these crypto companies. All of a sudden, their stocks are shooting up higher. They have plenty of liquidity to add more jobs and expand. But now their stocks already crashed. Now they have plenty of debt on their books, and the interest rate continues to move higher and higher and higher. And now all of a sudden, the demand for their products and services is nowhere to be found. What do you think they're going to do? Cut down their expenses, aka getting rid of employees. So you can jerk off all you want to the employment numbers and say, hey, the economy is strong as hell. But buddy, you have no idea what's about to hit you. And then, of course, they talk about, the Inflation Reduction Act. All of this spending by the fiscal policy. That's going to solve it. Oh, really? Because it seems to me that all of these spending bills are nothing more than money laundering schemes. They said we have to spend about $60 billion worth of taxpayer money for the CHIP Act to build all of these chip factories. It's going to add jobs. Come on. We know it's corporate socialism, but it's going to add jobs. And all of a sudden the bill went magically, of course, from 60 billion to over 120 billion. And I say win jobs, right? Win jobs. When are we going to get the jobs? Because Intel, which is the top beneficiary from this bill, is actually laying off over 12,000 employees. So much for the jobs. The millions of jobs. They're so worth it. We have to do corporate socialism, folks. Because jobs. Well, here's the jobs for you. So when people like President Joey B. and other economists and analysts and propagandists and pumpers or whatever they are, when they say, hey, the economy is strong as hell, I say the economy is skating on thin ice. And it's just a matter of time before something breaks and whoops. But until then, we got to move on here and cover the stock market information for you. And we begin with the closing of the indices today. And here we go. The Dow Industrial Average down by 90.22 points, or a decline of 0.30%. The Nasdaq down by 65.66 points, or a decline of 0.61%. The S&P 500 down by 29.38 points, or a decline of 0.80%. The sector's performances pathetic for the most part. It was actually a lot better in the morning when technology was leading the pack, but then came the commentary from Harker, and down we go. Yet keeping some of the gains and closing at number 1 and capturing the gold medal, energy. At number 2 for the silver, technology. Number 3 for the bronze, communication services. Yet the laggards of the day led by utilities. Interest rates are moving higher, utilities are moving down, no surprise here. But then we have industrials and cyclicals also leading the declines in today's tape. When it comes to the advance to decline ratios, NYSE 31% advancing versus 67% declining. The Nasdaq 40% advancing versus 56% declining. On to commodities. Now the dollar was down initially in the morning and therefore we witnessed a rally in commodities, but then came the hawkish commentary by Governor Harker. and it sent the dollar in a U-turn, and it managed to close at the highs of the day, be it on the flat line. But regardless, some commodities managed to close in the green. For example, crude, the WTI, Brent, all in the green, be it modestly. And then we have modest declines for gasoline, RBOB, while heating oil down about 3 3/4%, and natural gas down yet again by a little over 2.5%. And we know that natural gas, the demand went down, and the reason is European countries believe that they have enough in stock right now. And guess what? They're buying more Russian LNG. So we have all of this morality lessons and shaming. Why aren't you in the Saliva Ukraine camp? Why are you calling for peace? We're going to stand with Ukraine. In the meantime, they're buying Russian natural gas, LNG in this case, and sending more cash to Vladimir Putin. They're sticking Putin with that cash. And they're doing so because Erdogan in Turkey is now establishing a natural gas hub for Russian products, and the Europeans are buying Russian products out of Turkey. And that way they can feel good about themselves that they're not funding Russia, they're actually buying stuff from Turkey. To each his own. But anyways, when it comes to softs, we have yet more declines for coffee, down over 2% for the day, followed by sugar futures down about 1.25% for the day, and then cotton down about 1%, yet we have modest gains for cocoa, OJ, and lumber futures. Yet the majority of the rally in commodities came from metals with a catch. So silver up, platinum up, copper up, palladium up, all up big. Palladium over 3.25%, copper almost 2.5%, platinum almost 4% worth of gain. But the old guy, the mature guy in the room, gold, did not participate in the rally today, as if gold is saying, hey, watch out, the dollar is about to pop higher again. When it comes to meats, flattish action across the board, be it negative for lean hogs and feeder cattle futures, yet we have positive action for live cattle futures. When it comes to grains, green across the board, soybeans up, corn, wheat, rough rice, canola, all in the green. The laggards happen to be oats. And then we have a pause here in the rally, the significant rally, I should say, in soybean oil futures. Moving on to the big casino, the options market. What's going on here? The volume moved slightly higher in certain names, and we saw some improvement in the put-to-call ratio, but not by a lot. At number 1, Tesla, with around 3.5 million contracts traded today. About 54% of those were calls. I know at least a dozen folks who bought the dip in Tesla today. Said Tesla down too big, Elon is a genius. Gotta buy the dip. And they bought a lot of calls, and they felt pretty good, let's say all the way till 9 o'clock afternoon Eastern, when we got the U-turn, the 180, and Tesla closed at the lows of the day. But if we look at the bright side, these folks who bought the dip in Tesla are not going to have to suffer from pie inflation this upcoming Thanksgiving, because they got their pies for free today. Enjoy. And at number 2, Apple, with around 1 million contracts traded today, about 54% of those were calls. At number 3, Nvidia, with about 725,000 contracts traded today, about 53% of those were calls. On to the unusual activities that took place in the options market today. What about the ticker QQQ, the Nasdaq? Somebody's fading the rip. I mean, what rip, right? But anyhow, somebody bought the 245 puts for the expiration date, December 2nd, with expectations that the Nasdaq could go down and lose more than 9% of its value by then. And they paid around $4.35 a piece to enter this trade, all in all, spending around $4.3 million. And then what about the ticker META? I'm not going to read this trade because we should change the ticker to PIE. Pie, because somebody bought calls big time on Meta, expecting Snapchat to pop. They did not want to pay the premium for Snapchat. They thought they're smart by buying calls on Meta. Now they're getting a massive pie right in the face. So we're going to go to the EMB, the Emerging Market ETF, and this is a called spread. Somebody's betting for an upcoming upside here for the EMB, and they're doing it the safe way, using a spread. They bought the 81 call and they sold the 83 calls for the expiration date, December 16th, with the expectations that the EMB could move higher and gain more than 5% by the expiration date, but not more than 7.5% by then. They paid around $1 a piece for the 81 calls, and they received about 60 cents a piece from selling the 83 calls. All in all, the entry cost is reduced to about 40 cents a piece, and the total spent for this trade comes up to $200,000. And lastly, at the bottom of the table, what about the ticker GOOGL, Google, the big Goog, Alphabet? Snapchat is down after hours, Google is down after hours, Meta, you know the story. And somebody's bidding for more pain to come. They bought perhaps bidding against Nancy Pelosi, by the way. But anyways, somebody bought the 88 puts for the expiration date, November 4th, with expectations that the big goog will go down and lose more than 12% of its value by then. They paid around 85 cents a piece to enter this trade, all in all spending around $365,000. On to the heat map. What's going on here? There was an attempt for a rally in technology, and not all of it frizzled away. The majority of the bets were in chips. Yesterday, we covered a trade, a multi-million dollars worth of trade, a bullish trade for the SMH, the chip ETF, and chips did okay, at least initially, and then the majority of the gains faded away. Yet we have some green pockets here and there. For example, we have Oracle, CRM, Salesforce, IBM on the heels of earnings, and of course more short covering in the chip equipment manufacturers ASML, Lam Research, AMAT, all in the green for the day. Of course, AT&T was in the green, but do you buy it? The most boring name ever? Of course not. Yet the majority of the pain came from cyclicals, industrials, utilities, the defensives, Tesla, of course, and then the banks. The rally in banks, the optimism. It appears that the optimism is nothing mere than a pump and dump, and the optimism did not last for too long. Now, let's talk about some of the major movers here, and we start with Allstate. Allstate was down big. You're in good hands. And the reason is they're warned of a surprise loss, but here's the important part. Even though auto insurance rate jumped by 16% month over month in some locations. You know, the auto market right now is the subprime auto mortgage, auto loans market, the same kind of reckless risk-taking that we've seen back in the housing market in 2006 all the way to 2008. This happened in 2020 and 2021 all the way to 2022 in the auto loans market. Some of these loans are over $1,000 a month, and this is becoming a common thing where folks are paying over $1,000 a month in auto loans, not mortgages. They're paying over $1,000 a month for the car because the car is the house too in this economy. But anyhow, we also have a stunning move here from Alcoa. Alcoa opened down about 10%, but shortly after the open, Alcoa moved higher, scoring gains of over 10% before settling down. And of course, we know the global economy is in a stagflation / a recession phenomenon. The thinking is aluminum should go down, but we have the pent-up demand. We have the aggregate demand. All of these EVs, the green energy stuff needs a lot of aluminum. And on top of that, we got news that the U.S. may block Russian aluminum imports. This will create a shortage of supply. So the traders looked at it as an opportunity to buy. Alcoa down 10%. They got it down there and they moved it higher all the way by over 10%. A massive ride. If you got it at the bottom, moved it all the way to the top. This was a ride worth about 20% in a single day. Unbelievable. And then we have a name that I'm short, Blackstone, and the earnings for this company went down by 16%. I remain short, and I say the more, the merrier. And then we got news from FedEx, and the company is finally axing the Roxo delivery robot, and apparently the robot did not do so good in the hood. It got robbed over and over and over again, and by the hood, I mean Beverly Hills, because that's the hood now, with the crime wave in America. And then we got news from Tesla. Tesla says, pedal to the metal. Elon Musk says to the workers, while cracking the whip, work harder, pedal to the metal, get us all of these deliveries, make more soufflés now. And he wants them now because he knows he's going down. The problem is with this pedal to the metal strategy is we're going to have an oversaturation, oversupply of soufflés in the market. So if you're waiting to buy a soufflé, wait more. Good things come to those who wait. You're going to see an abundance of soufflés in the market for pennies on the dollar. When all of these crypto workers lose their jobs, all of these white-collar workers in the tech companies that got inflated wages, they lose their jobs, they're going to get rid of the soufflés and you're going to pick them up for pennies on the dollar. This will be a big problem for the stock because oversupply means lower prices, and lower prices mean lower margins, and the investors are not happy when Tesla is losing margins and the growth in the company is slowing down. But Reverend Elon has big dreams and he has visions and such. Like scams and Ponzi schemes. And he says that he sees Tesla's valuation soaring all the way to $4.4 trillion. And Twitter is going to be worth over $400 billion. And Tesla will be worth more than Apple and Aramco combined. Here's the catch. But he's also begging the Fed to stop quantitative tightening and says the Fed should cut rates. Because damn it, my stock is going down and I made a lousy deal buying Twitter for that much, but I stuck my foot in my mouth and now I cannot get it out, so I have to do it and buy it. Unfortunately for Elon, the Fed is not in charge. The Fed is not going to cut rates to accommodate his ass. Inflation is in the driver's seat, and inflation says the rates are going higher, and Tesla's going lower. So forget about the $4.4 trillion bullshit. And now we're getting news from former marketing chief in Tesla who says that Elon Musk can be like a toddler and having tantrums, quote unquote. And I was seeing this person that was taken by anger. So apparently the Rev has a darker side, and this usually happens when he transforms back into his Martian shape. And then we got news for LMT, Lockheed Martin. Good news for LMT so far this week. Up big, lots of money being made. Dividends, buybacks going higher. The taxpayer money, beautiful. But the fundamentals are also good because all of this war in Ukraine is depleting our own military equipment. For example, all of these HIMARS that we gave to Ukraine, well, we have to replenish all what we gave them. And this means hundreds of millions of dollars worth of government money. It's not actually the government money, it's taxpayer money, all the way to the pockets of Lockheed Martin. Which company, again, that is experiencing booming business at this stage? Snapchat, Meta, Tesla, or Lockheed? Anyways, what about the heat map for the ETFs? Down for the most part. The exception is the inverse ETFs, specifically the TZA, the inverse of the IWM, the Russell 2000. So the majority of the weakness is from small caps. We know that. And as yields move higher, we talked about the XHB, the Home Builders Index, down big, almost 2.5%. But look at the rally in financials. The KRE, for example, down almost 3.5% for the day. The rally is frizzling out. The rally was short-lived. Some short covering, some quick buck. And then what? We all know this economy is trash. You cannot really buy the bank based on the rise in yields alone. What about the trading revenue? What about the slowdown in loan growth? All of this is bad for banks as the economy heads into a recession. When it comes to commodities, the GDX gold was higher, yet the GLD was down. And the reason is we have some earnings from certain miners, and that pushed the GDX higher. And today, we don't have a contrast between growth and value. Both are down. When it comes to internationals, the EWZ, Brazil, is leading the pack, and this will be extremely volatile until we get the results from the runoff elections. Now, let's move on to charts, and we start with the SPY, the S&P 500 30 minutes chart. What's going on here? The chart lost the most important support of 368 and the gap support by the end of the day. That's gone now. But the bulls would argue, hey, no harm done because we're keeping the June bottom at 362.16. Who's to say that this is just a mere pullback, a gathering of energy, and then higher we go again? Here's the problem. So far, the pattern has been lower highs and lower lows. And if this trend continues, sooner or later, we will see the June bottom gone, kaputs, and then the gap, and then we'll make lower lows. Too early to say for now, but there is no doubt that the bears are regaining some control here. What about the daily chart for the continuous contract for the SPY? Again, the volume is below average. This is bullish, not bearish. The momentum indicators are positive for now. This is bullish, not bearish. However, the chart lost the most important support of 3,720.5. This is bearish, but is it the end of the day for now? Is it the end of the run higher, the rebound, whatever that is? The answer is not really, because the bulls would argue, what if this is a bull flag consolidation pattern? Sooner or later, we will see a pop, and the chart's going to recapture 3,720.5. A matter of fact, move all the way to the top of the reversal pattern at around 3,820. Can you bet on it? The answer is all of these hopes will go out of the window the moment the chart goes all the way down and retests 3,600. Because if there is a retest, it's going to be met with failure. It should have been enough that the chart retested 3,600 twice, actually more than twice. If that was not enough, then the next move will be down, and 3,600 will become resistance, not support. When it comes to the Qs, 30 minutes chart, once again, holding onto the June bottom at around 269.29, but the bad news is the formation is showing lower highs. If this continues, sooner or later, the June bottom will be gone, and we will be eyeing closing the gap below. Here is the daily chart for the continuous contract for the Nasdaq, again, below the June bottom, but the bulls would argue, what if this is a bull flag pattern? Let's play that game. You want to play that game? Let's play the game. But by tomorrow, if the chart doesn't move higher, we're done here. We're going to go down in a retest of the lows, The lows are not going to hold, and we will see a flush down coming in the Qs. And the excuse could be, I'm just reading the tea leaves here, maybe Google is blowing up. Maybe Apple's earnings are not good. What I'm saying is, even if we have a move down, don't expect the flush down to happen before we get one of these bombs. It's not going to happen without a catalyst. And here's the IWM 30 minutes chart. What's going on here? It was the weaker of the three, the SPY, the Qs, even the Dow Jones. The IWM was down the most. And it went down all the way to the support of 168.90, and it is holding on right now. Here's the problem. When we clean up the chart, we have a pattern of lower highs and lower lows. And if this holds, the next step will be a flush down all the way to 164.91. The Dixie, the dollar index daily chart, what's going on here? Is the bull flag playing out, or is the reverse ABC pattern playing out? I say the bulls have it here, dollar bulls, at least for now. Now, the reverse ABC pattern is still here, but it's getting weaker and weaker and weaker by the day. For now, look at the RSI. We have a negative divergence, and this supports the last breath by the reverse ABC pattern hopes. If the RSI passes below the negative divergence and we see a pop higher in the dollar, it means the reverse ABC is over, and equity bulls, dollar bears, will argue that, oh, the next step is a double top, so we're going to play that game. But in my opinion, if the bull flag plays out instead of the reverse ABC, then all of that energy from the consolidation will be released all at once, producing a massive pop higher. It might not even stop at the double top. It might cut through it like hot knife through butter. And the confirmation here is gold. Here's the daily chart for gold. It is now holding at its own lows. If it fails to rebound, it means it's going to go down to make a lower low at around 1600. If that is the case, the dollar will make higher highs. No double top. Here's the Brent oil daily chart. What's going on here? Are we seeing the ABC pattern playing out? It is still here, and this is the consensus for now. But again, if the dollar pops higher big time, oil bears would say, hey, this is or will be soon a bear flag consolidation pattern, which means we will go down to 85 once again, and oil bulls will play the double bottom hopes. If the double bottom doesn't happen, and the likelihood is if we go down there again, it's not going to happen, it's not going to hold, then we will see a flush down. Oil goes down, dollar goes up. Believe it or not, this is not good for equities right now. But in the long run, even if the dollar goes down and oil pops higher, this is also not good for equities because it pushes the Fed to be more aggressive as inflation moves higher. In other words, the bulls are toast in either scenario. Doesn't matter. Dollar goes higher, dollar goes down. The bulls are going to lose either way. This is how tough this market is. When we talk about yields, a daily chart for the 10-year, all of that energy from the consolidation is being released now that we have a breakout. So we're not going to play the game of marking any resistance here. That means nothing at all. It's going to stop when it stops. But for now, the assumption is all of that energy is being released right now as we speak. And it's not done yet. There is plenty of juice for the 10-year to continue to move higher. When we look at the TLT, a weekly chart, the flush down continues, and we're eyeing once again 87.94. The 10-year yield is in a breakout. The TLT is in a breakdown. When it comes to the VIX 4 hours chart, what's going on here? This is the only chart that really gives some hope to the bulls. We're talking about equity bulls because the trend line is gone now, and the MACD indicator remains negative, indicating that the VIX is in bearish momentum. Now, we have some support below, as you can see, and the assumption for now is if the VIX continues to go down, will it catch support from that point on? This is the assumption for now. You might see a phenomenon with the SPY going down, yet the VIX is also going down. And the reasoning behind that is traders and investors are not seeing the need to buy puts and hedge, even though the SPY in the market is going down. However, we got Tesla moving down big after earnings. Now Snapchat. What's next? If the market starts to get nervous here about the upcoming earnings that we have, you will see more buying of puts and the VIX moving up again. So I say if you see the VIX moving down all the way to the support that you see on the screen right now, and then it rebounds higher, it means that traders found a better price for the puts they've been eyeing, and they decided to pull the trigger and buy these puts because they're getting more bad news, be it from Tesla, from Snapchat, or whatever else is coming, and they're getting a lot nervous about their own holdings. So they have to hedge by buying puts. For now, market participants are not seeing the need for these hedges. No need to buy puts for now. the market is down big, oversold rallies, etc., etc. But if they feel that they're about to get it wrong, they're going to stampede in buying the VIX. On to Apple, 30 minutes chart. What's going on here? No update. The chart made it for a little bit above 145, but then it lost that support, moved down, retesting the support of the gap, and then it closed above that gap. So for now, within range. No update. Nothing happened today. But the bears would say, hey, Apple did not make it above 145. This happens to be not the first, not the second, but the third time in a row where Apple loses 145 as support. Isn't this an indicator that Apple doesn't have the energy to crack above 145, and down we go? And this is certainly a persuasive argument by the bears, to which the bulls don't have a lot of response. Tesla, an hourly chart, what's going on here? A gap down below 206.86. The gap is closed, run for the hills in the morning, but the dip buyers did show up, and they closed the chart pretty much at the support, if not above 206.86. The bulls would argue that this is an A, B, C pattern in the making, and soon enough the name will pop higher to close the gap above. Now, this is all good stuff, and it could happen. However, if we have a loss of 206.86 again as support, it's not going to happen. We will see the chart flushing down yet again, because a lot of folks bought the dip in Tesla, I should say, be it via stocks or options. So if the chart goes down, closes below 206.86, and it makes a lower low, lots of capitulation will happen. A lot of folks would say, okay, bad timing. We pulled the trigger a little too early, time to reverse course and dump the name. And this could exacerbate the move to the downside. And lastly, Bitcoin, what's going on here? No update, within range, but here's the take. Isn't this a series of lower highs? And we have a support that is about to be broken. If that is the case, the next retest will be all the way to the lower range of the consolidation pattern at around 18,000. If that doesn't hold, then the flush down begins. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have some inflation expectations for the 5 to 10 years and then the 10-year beyond. And this will be really important to watch because the Fed is watching. And of course, when it comes to the earnings calendar, we have Verizon and American Express. With that, folks, I'm beyond exhausted here. You might have heard it in my tone tonight, but this is what I do. With that being said, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again over the weekend. Take care.
He presents himself as this harmless old codger, but inside doesn't matter.